Our next guest is a good friend of mine, a big real estate investor here in San Diego, and one of the best mortgage professionals in town. Please welcome to the show, my good buddy Sean Cahan is here. Sean, how you doing, man?
I'm doing awesome. How are you?
Hey, great to have you, brother. A lot of stuff going on in the mortgage world, the real estate world. It seems like the market's still on fire. Is that your perception from the mortgage side of things?
Yeah, absolutely. Home prices are still really steady right now. Interest rates are really historical low, even though we've kind of heard that terminology for the past like 3 or 4 years. It's still historically low. So
yeah, well, anytime you have 4% anything, that's a historically low rate because it's never happened until 5 or 6 years ago for the first time.
Correct. Yeah, exactly.
Or you have to go back like 60 years the last time they were there. You're also a big investor, so we'll talk about real estate today and that side of things. I really want to pick your brain on that and kind of where your head's at right now from an investment perspective. But I'm also curious about the changes now, the TRID.
Yes.
Which a lot of consumers don't know about this change in the process. A lot of people in the industry don't know about how this is going to affect things, but I know that you have become an expert on this. Tell me, what are the highlights of what TRID is doing to the real estate transactional process?
I think TRID is it's an amazing document that's coming out. It's replacing the HUD. It's getting rid of the HUD, getting rid of the GFE, and also getting rid of the TIL. And it's combining them into one nice, easy to read form. It's also really good for the consumer and also really good for the mortgage professional, because I think that a lot of the time the difference between the TIL and then we look at a HUD or we look at a GFE depending on, and so they all kind of are created by different individuals, and so then there always can be inaccuracies. And so somebody will say, like a consumer will say, hey, we need, what are my cash to close? And they'll be looking at a HUD. Well, the HUD is created by escrow. And so if they, go back to the GFE, that could actually be different because the GFE shows total settlement charges. Does not mean you're responsible for it. Does not show credits unless you actually put it in box A. So it's just like little things like that where it's kind of like saying, hey, we're out. We're going to get rid of these really confusing forms. We're all going to put it down. And to be honest, now the mortgage company or the lender or the brokerage is actually the one who gets to create the TRID, so they get all of the fees, and so their numbers are the most accurate numbers.
Wow, so that's huge. If you're getting rid of the GFE and the TIL, the truth in lending statement, and the HUD, that's like you're ripping all of the heart of the documents out, and they're replacing it. You think this is a good thing. So
amazing.
It's amazing.
Yes.
So they did a good job in revamping this stuff. I was afraid that whenever the government goes in and says, oh, we're going to create new documents, usually they just add on to it. But in this case, they actually took stuff away and put in something that is going to work well. Here's the thing that really sticks out to me about what you just said, is that the lender gets to basically control the calculations.
Correct.
Control the numbers to know how much cash someone needs to bring to close when they're buying a home. A lot of homeowners don't think about this. It's just one of the little things that adds up in the pile of stress that can be buying a home if you go through a rocky process or you're working with people who don't know what they're doing. Oh, how much does a check need to be? I got to get a cashier's check. Well, it's $22,621. Oh, nope, actually it's $24,700. It's like,
exactly.
Man, you got to get these things right. So now what you're telling me, it sounds as if that won't happen anymore.
No, it will not happen, or it shouldn't happen at least, because the loan estimates are going to be being sent out from the lender, and then the closing disclosure is actually the last one that gets sent out, and that's supposed to be done, and then the consumer has 3 days from actually receiving that document before the loan docs can be drawn. So it really does give them time to kind of settle down, realize what they've seen, realize that they're making the decision, because once you do kind of technically sign, we want to move forward to close. And so we're kind of getting away, and almost the TRID is kind of table funding, wet funding type of deal also. So it's more of, hey, here's the final numbers, they cannot change. But there is one big difference between institutional bank, credit unions, and mortgage lenders or direct lenders like ourselves, is that they say that you have to resend out a closing disclosure and wait the 3 days. If there's any changes to any of the numbers, TRID actually says in their guidelines that it's actually only 1/8 of a point. So it still follows that same guideline. So you can extend it out and not have to wait the 3 days if it doesn't move more than 1/8 on the APR.
I'm glad you brought that up, because the real concern in the industry that I've heard is that TRID is going to establish a new timeline, is going to make transactions take much longer. Is that what you think is going to happen?
I mean, it is going to take much, much longer if you're working with an institutional bank or a credit union, because they're taking their closing disclosure, called the CD, and they're actually going to be sticking it in the mail. And then they're going to wait 6 days from them sticking it in the mail before they can place the loan in line for docs.
Wow. And for a purchase transaction, I just can't imagine. I mean, there's so many moving parts. Daily interest that has to be calculated and all those things. I mean, what?
Nothing can be changed.
I mean, how are you going to get it right? That's so crazy. Well, I mean, I'm surprised that they created something that's bad for the institutional banks, but hey, it's good for you. It's good for people, mortgage professionals who know what they're doing, who've studied this stuff, and who have set up a process to help people execute using the new rules. So
absolutely,
I'm glad to hear it's a good thing. Really am. Let's talk about investing. Is that cool?
Love it.
So you own a lot of properties. You're always looking to buy properties.
Yes.
In San Diego especially. We've joked on the radio before about how you've missed all the years in Ohio and Michigan and Oklahoma and all the $20,000 houses out there. But you stayed right here in Southern California.
I did.
And that's worked out really well so far. And what do you think right now as far as investing is concerned? Is the market too high? Are the deals gone from this cycle?
I mean, it's like a vast majority of every single deal being a wonderful and perfect deal. Yes, it's gone. But if you're working with the proper people, if you're working with the proper numbers, you do have the down payment. You do kind of look at it like, okay, how am I going to value add to the property? So if you're just trying to take a property, put down 20% and cash flow at, one-to-one basis, it's not going to work.
Okay, that's not out there.
It's not there. But
so what is there then?
Value added.
So that's improving the property.
Yeah, adding, bedroom, 2 bedrooms, really remodeling the property and to bring it up to code where I think code should be today.
Mm-hmm. So that's finding a 2-bedroom house and making it a 3-bedroom house.
3-bedroom, 2-bath, really upgrading it too, changing, taking out. A lot of investors do it reverse, okay? They take it and they try to do as minimum as they possibly can, and then they get the middle of the road or try to get for the higher rent, but their place still is not that great of a place, and so then they get the middle of the road. They try to make little tweaks that kind of break down in like 2 or 3 months, and then they try to rent it, and then, come down the road. Now their places, they don't spend the money on the termites. They don't spend money on the actual upgrades. It's like they just put lipstick on it and call it a day, and that stuff breaks down.
Yeah, it does. It does. And you can tell. I can tell.
Absolutely.
When I walk into one of those properties, it's really, really obvious when you have 50-year-old windows and brand new, Formica.
Yeah, exactly. Right?
It's like, something's not right here in this house. I think this is a flip. But what do you think about the buy and hold strategy, at least at this point? Because what you're talking about is flipping, right? You're talking about
buying and holding.
You're talking about buying and holding?
Yeah, buying and holding. Like, if you expect to just buy it and it to work, it doesn't work today. Like, buy it, remodel it, long-term it.
Gotcha.
Yeah.
So you're talking about going and completely changing the property, really investing into it, not just the down payment, but investing in the renovation, and then getting the top rent dollar.
Correct.
And keeping it. Very interesting. So that's where you're at right now.
Yes. Trying to buy a lot more if anyone's watching.
If there are any good deals out there, and if someone's got an ugly house for sale,
I will create a good deal.
He'll make a good deal out of it, this guy.
Or I'll try.
Here's what I think we should talk about for the average person out there is, how should they look at their home? Should they look at their primary residence as an investment, Sean? I mean, this is something you work with people every day who are going through this. Should they think of the home that they're buying to live in as an investment?
Absolutely, yeah. And don't strip all the equity out of it. I mean, it has to be a place where you actually need to live, right? And actually have to enjoy it. So I want you to live there, enjoy it, but I need you to look at it as an investment as well. You can kind of, not all investments are meant to be kept also. So I think a lot of the time individuals will look at their primary residence and say, well, I'm going to rent this out and I'm going to go buy another primary residence, or we're going to take cash out of this place. Well, you bought it as a primary residence. You never did a rent schedule on it. Don't keep it. It's not a rental. It's more of an emotional purchase. So I think a lot of people make that mistake and they go, oh, I'm breaking even. are you really breaking even? I mean, you have vacancies, you have repairs, you know, if you're keeping it up properly.
Yeah, you got to factor all that stuff
But
in.
you definitely need to look at it as an investment. I think a lot of people just get emotionally attached and they get in the market and I need, instead of actually sitting down and realizing what they're purchasing.
Yeah, fantastic advice from one of the best mortgage professionals here in San Diego, Sean Cahan. If you missed his TRID event, Industry Professionals, give him a shout. He can give you a special link to catch all the details about what's going on with TRID. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.